Investing like the wealthiest. Why and how to create your own private vault, be your own private bank, and warehouse your money like the wealthiest 1%. When it comes to investments, some are short-term, some are long-term, and some are for a lifetime. Why do people invest? That's easy. 100% of us care about our finances. 100% of us want to grow and protect our money, and 100% of us want to create a better lifestyle for ourselves and family. Many times, the road to saving and the road to investing don't always go to the same place. That's when we struggle to choose which path to take. Where do we put our money? Where do we warehouse it? This video is going to show you how to take control of your investments using your savings. With the private vault account, the paths to investing and saving go to the same place. I'm literally going to show you how you can turn $1 into $150,000 tax-free over time and with no risk. This is a structure and strategy that's been used over the last 200 years, but many just don't know about it. Walt Disney used it to help fund Disneyland. Ray Kroc used it to help make payroll for McDonald's upper management employees during the lean times. And James C. Penney used it to help build his retail empire. The three crucial points that end up taking our money. First, with inflation, your dollar is getting cut off every year by 2%. Later in the video, you will see how the power of 2% can affect you over time. Second, everyday expenses add up. Car payments, house payments, health insurance for the family, and the list goes on. And third, the IRS. Taxes cost money, and they take a significant amount of it. Continue watching this video, and you will see how the personal vault account can combat high taxes. When it comes to taxes, whether you are high or even upper middle class, making at least $84,000 a year, you're in a tax bracket between 24 and 35%, and that is just for federal taxes. Now, if you live in a state that has state income tax, that's extra, and it can really add up. California leads the country in state income tax. There, state income tax brackets can go as high as 15% a year. Merely making $56,000 a year has you paying almost 9.5% of your total income to the state. But if you feel bad about that, you really shouldn't. If you look at the history of taxes over the past 100 years in this country, those in the highest tax brackets were paying somewhere between 80 and 90% of their income. All through the late 60s and entire 1970s, higher earners paid well over 2/3 of their total income to federal taxes. The Vietnam War was very costly to high-earning taxpayers 50 years ago. When will the next major war break out and affect taxes? What will be the next economic crisis? If you take a look at the federal budget, outside of paying interest on its current debt, the Social Security program, health care, and the Defense Department are the biggest expenditures. And with all of the baby boomers now retiring and getting payouts from the Social Security program, we might see another tax rise again in the next 20 years. And if another war breaks out, there's a good possibility of another big tax hike. When it comes to investment vehicles and taxes, there are three types. Those taxed upfront and on the back end. You make your money at your job, use after-tax money to purchase stocks, buy real estate, or deposit it in some other investment vehicle. When you sell or cash out of the investment, the profit you made is taxed. Second, are investments that are taxed on the back end only. Many Americans have a 401k or an IRA. The money you put in is tax deferred. You continue to contribute earnings. After years of your money compounding and growing, when it comes time for you to tap into your nest egg, you first have to pay taxes on the total. Only now you're in a higher tax bracket than you were when you first started contributing. And as a result, 40 to 50% of your account will go to the government. And last, investments that are only taxed on the front end. With the private vault account, you pay your taxes up front, and the money that you make from it is tax-free. Why pay taxes on the harvest when you can very easily pay a smaller amount of taxes on the seeds? Now that we have covered the tax aspects of an investment, let's move on to the risk management aspect. We all know who Warren Buffett is, and when it comes to investing, he has been quoted as saying, "The number one rule is never lose money, and the number two rule is never forget rule number one." With your money in a personal vault, you have what is known as index protection from losses. If you don't know what indexing is, you soon will after finishing this video. When it comes to risk, the three types of investments are categorized as high risk, high reward, which include putting your money into stocks, startups, real estate, and even some high yield mutual funds. The second class would be for the 401ks and IRAs. While much more conservative than the risky investments, they are tied to the market and the S&P 500's performance. The third type is risk-free. Savings accounts are risk-free, but by the time inflation kicks in, you're basically paying the bank a fee for having them hold your money. Another risk-free investment is putting your money into your own personal vault account. This is where the wealthiest 1% warehouse their money, risk-free due to index protection, all while still earning high dividend benefits that mirror the S&P 500 and still have access to it. Now let's discuss the difference between the average return versus the actual return. Let's say you put $1,000 into the market or another investment vehicle. Now in the first year, the market goes down 50%. So that is a negative 50% average rate of return. And in the second year, it goes up 50%. So the next year has a positive 50% rate of return. That sounds like the same rate of return, which would bring you back to even, right? Well, that is not how your actual return works. As you can see, in year one, you start with $1,000. The market goes down 50%, so that leaves you with $500. The next year, the market goes up 50%. So you have a 50% return on your money. But 50% of $500 is only $250, which now gives you a total of $750, which is $250 less than your original $1,000 you put in. And so the actual return is a 25% loss. Of course, the higher and lower rates of return in this example are drastic, but it illustrates the difference between rate of return and actual return. If you park your money in the market, then you know it has many small rises and falls. While the losses might be small, they do take a toll over the years and slow down your nest egg's growth. And if you don't know what you're doing, putting money in the market is basically the same as going to a casino and rolling the dice. Aside from the risk, if you need accessibility to your cash, you definitely won't make returns if you take your money out of the market in case of a medical or family emergency. The private vault account grants you access to your money while still enjoying growth and safety from the risk of loss in the market. So how does this private vault account work? This chart illustrates how the private vault account would have benefited a 42-year-old if their parents would have started one of these for them back in 1977 and put only $1 a day in the account until he or she was old enough to start depositing the dollar themselves. So here we have 1977 up to our present day. To show the unique benefit of index protection, we are going to compare the growth of a mutual fund linked to the performance of the S&P 500. The left column is how the mutual fund performed each year, and the right column is the personal vault account. At 42 years old, or 15,695 days old, the total out-of-pocket investment would be $15,695 for both columns. But that is where the similarities on the two charts end. Over the 42 years, the S&P 500 column on the left took a loss 9 times, and 15 times it had gains over 15%. But if you remember what we just discussed about the difference between rate of return and the actual return, those 9 years of losses overshadowed the 15 years of high gains. Now look over to the right at the personal vault account. While the personal vault account has an earning process that mirrors the S&P 500, it is more consistent. Over the 9 years where the market took losses, the private vault account avoids the hit and merely has 0% growth. And on the 15 years where the market enjoyed growth of over 15%, the personal vault account was capped at earning 15% on that year. You give up the few large inconsistent gains in exchange for enjoying absolutely zero risk of loss. This is what is known as indexing, and its protection from losses outperformed the S&P 500 gains over the past 42 years by over 67%, or $10,481 in this dollar-a-day example over the last 42 years. This is not a projected return. These figures are based off archived factual data that anyone can research and verify. In addition to the extra 67% return on investment one would have seen from putting $1 a day into this account, rather than putting money in the market, there are other benefits. Remember, we also discussed the 3 investment categories when it comes to taxation. When you decide to pull money out of the account on the left, you will be federally taxed on that income bracket and paying over $32,000 in federal income tax. And for those that are residents of California, the state income tax will take another $12,000. That is a total of just under $55,000 you will have to pay. With the personal vault account, your money will be exempt from both the federal and state tax bills. So for this example, you would have earned an extra $55,000 or 351% extra return on your investment by putting the $1 a day into a personal vault account instead of a mutual fund or account directly linked to the performance of the S&P 500. For just $1 a day, you could have had $144,000 sitting in a private vault account waiting for you on your 42nd birthday. Thanks, Mom and Dad. I'm joking. I wouldn't hold it against my parents. They didn't know about the private vault account, but now you do. And one day down the road, when your kids turn 42, I'm sure they will thank you for starting a personal vault account for them now when they are only small children. There are also 3 categories of investments when we talk about expertise. The first category requires the highest level of expertise. It is a high risk and high reward. Stocks, real estate, and startups fall into this category. When investing in this category, the object is to jump on the gravy train for a hot stock before it goes up. But many times, individuals put money in companies after the major growth occurs because it's human nature to follow the herd, or panic and take your money out if you don't see expected returns soon enough. Unless you plan to stare at a computer screen of the global market around the clock, get lucky on a hot stock tip, obsessively read the Wall Street Journal and other trades, or spend all day calling a stockbroker, this is probably not a practical investment for you or most other Americans. And if you don't have the expertise to invest your money in this category, you will have to pay someone else that does, which will affect your overall return on investment. The second investing category of expertise needed is much lower, but you will still need a certain level of know-how. Knowing which market's performance of gains and losses your retirement funds are linked to takes a certain small level of research and expertise. And knowing what taxation is for someone in your individual situation when the time comes for you to access your money takes a small bit of studying or expertise as well. Now, the third category, the category that the personal vault account falls into, requires 0% expertise. But with the personal vault account, you can still make high-paying gains, like those in the high expertise category, with a conservative 0 amount of risk for losses and 0 expertise needed. 0 expertise needed and 0 risk. You can sleep easy at night. In addition to tax, risk, and expertise obstacles, the restrictions on most retirement accounts are impractical for most people to rely on as a viable vehicle to service the financial needs for their entire life. If you choose to put your money into a 401k, the maximum contribution annually is only $19,000, and you can't access that money until you turn at least 59 and a half years old. Unless you want to pay a 10% penalty, you are literally paying a 10% tax for accessing your own money after you pay the federal and state income taxes on it, which in most cases combine for around 40% of your nest egg. Let's say you do not need it and want to leave your money there. You're going to have to take it out by the time you turn 70 and a half years old, or pay another penalty in the form of an excise tax, because the government wants to collect on all that income tax you have been deferring for decades and decades, especially since your 401k is now in the highest taxable bracket it has ever been. At this point, when you are now not in the workforce earning the income you made while you were in your prime, Uncle Sam is now the most hungry he has ever been. This is the time you've been working and saving for your entire life. You want to enjoy life, live on your nest egg, or maybe even pass on a legacy to your kids or grandkids. Before doing that, you will end up paying the highest percent of income tax you've paid since you entered the workforce and started paying income tax 50 years ago. The personal vault account lets you put your own restrictions on your yearly contributions doesn't tax you for accessing your money before getting into your 60s, and doesn't have a mandatory age to withdraw it. The other alternative is to leave all of your money in a savings account. It isn't tied to the performance of the market, and you can access it any time. But you're actually losing money by keeping it dormant in a savings account. The interest earned on most savings accounts is less than 1/2 of 1%. If you take a modest inflation rate of 1% into consideration, you are actually losing 1/2 of 1% of your money each year. And once you take your money out, you start saving all over again. Whether you have your money in a savings account or have been stuffing it into your mattress for the last 20 years, you now have no ability to earn a rate of return on it once you spend it. With the private vault account, you can access your money and still get a rate of return on it. Another benefit, and probably the most underrated, is the ability to open this account early in life and utilize it for your entire life. An account where you can continue to earn impressive gains that compound into a respectable nest egg later in life, while still using your money through all stages of life. From paying college costs, buying a new vehicle, putting money into a new business, and then have it usher you through your golden years. This is where your private vault account becomes your lifelong friend and is head and shoulders above anything else. For many, a bank symbolizes money. It is a place that loans us money for vehicles, home loans, and other major purchases. But going to a bank for funding is expensive, and the interest they charge is a silent killer. Over a lifetime, most of us will spend over 1/3 of our after-tax income paying bank interest. This is how borrowing money from a bank for a loan breaks down. You get a 5-year car loan with an 8% interest rate. You think you got a great rate and are happy. You get a home loan and get a 4% interest rate, and you are even more excited. But if you look at your loan in the big picture, you actually pay 21% for that 8% 5-year car loan. And on that 4% house loan over 30 years, you really pay over 71% interest. On a 5-year, $10,000 car loan with only 8% interest, the monthly payment is $203 a month. Over 5 years, or 60 months, you'll pay $12,166 to the bank on that original $10,000, where $2,166 go to interest charges, or 21.6% interest. If you get a 4% interest rate on a $100,000 mortgage for 30 years, it's even worse. Per $100,000 borrowed, you end up paying over $171,000 over 30 years, or 71% interest. You have basically paid 3/4 of another home. Now, let's look at how a personal vault account can help fund an entire lifetime's financial needs. Or more specifically, how a 42-year-old could use a personal vault account today if their parents would have only put $3,650 in, or $1 a day until they turned 10 years old. Like the chart earlier, the two columns show the performance of the S&P 500 since 1977. On the left, we have money in a 401k or mutual fund. On the right, we have a private vault account. By leaving the money in the accounts and withdrawing the money at age 42, the account on the left gives you just over $53,000 after taxes, fees, and early withdrawal penalties. The private vault account gives you access to over $86,000. But what if you want to buy your first vehicle at age 20? The money in the account on the left would have a value of over $26,000. But after taxes, fees, and any early withdrawal penalties, that would leave you somewhere between $15,000 and $18,000. You take that money out, buy your first car, avoid paying interest to a bank, but now you have to start your savings all over. Either that, or you can get a car loan from a bank and end up paying that 21% interest over the next 5 years at $300 a month. After 20 years, that same money in a private vault account would have a cash value of around nearly $16,000. It is your money, and you are welcome to it. But instead of formally withdrawing it, if you borrow that money to purchase the vehicle from your private vault account and keep your account open by making the same $300 a month payment to your private vault account instead of a bank, only now it is an interest-free payment, and you can continue to earn interest. After the next 5 years, you've paid your personal vault account back, and you continue enjoying the compound interest it earns. This process can be duplicated for the rest of your life. Perhaps 10 years later, you decide to start a small business. You now have over $30,000 at your fingertips. Borrow the money interest-free from your personal vault account and pay it back over time as your business grows and flourishes. By age 40, maybe you decided it's time to graduate from that starter home you're in and buy a home that will last you another 10 to 20 years. You now have over $75,000 to use for a down payment. Borrow that money interest-free from your private vault account and pay it back over the next 2 decades. During this time, your private vault account continues to earn handsome returns until it is time for you to retire. This really is a lifetime savings account with epic benefits and advantages over almost any other passive investment. None of us know exactly what the future holds, so we cannot say exactly what the private vault account will be worth in 30 years from now. But if you use the track record over the first 42 years as an indicator, which had an average of 8.65% growth a year, by the time someone born in 1977 turns 72, their private vault account could be worth just over $1 million. Imagine having $1 million for retirement just because your parents put $1 a day into a personal vault account until you turn 10 years old. While none of us can jump into a DeLorean, hit 88 miles an hour and go back in time to the early 1980s, say to give ourselves the next 35 years of Super Bowl winners or make ourselves buy Apple stock, we can warehouse our money in a private vault account today and enjoy the benefits down the road. Or we can start $1 million nest egg for our kids and grandkids. Accessing your money and investment profits is easy. When you are borrowing from your personal vault account, you're automatically approved because you are the underwriter. Also, there is no impact to your credit when you borrow from your own personal vault. The money you borrow from your personal vault is interest-free and tax-free because you only paid taxes on the money you originally earned, so the capital gains are all yours, and you can access your funds within 48 hours. With a private vault account, you really are the boss of your savings and investments. And as an extra benefit of the personal vault account, the cherry on top, in any event that something happens and you pass on from this mortal coil, your wealth transfers to your heirs without probate or inheritance taxes. The government does not get to take a big slice of your legacy's pie. It all goes to your family and intended loved ones. And in some cases, the face value of your personal vault account can even provide 3 to 5 times the cash value. There you have it, the personal vault account. Whether you're looking for a savings account, a place to warehouse your money and park it somewhere that is protected from losses, yet still earn attractive returns with no risk, or if you want to grow your money tax-free, the personal vault account is a lifestyle account, and we can tailor-make one for any W-2 employee, small business owner, mega wealthy entrepreneur, or any parent wanting to help plan for their kids' future.